afternoon, ladies and gentlemen. My name is Matthew Pereira, and today I'd like to go over Investing 101. This course is basically designed to provide people with basic knowledge of the investment world, and I'll share some of my personal insights. Now, before I continue with this course, I want to make a disclaimer that I am not going to provide any of you tips on what stock or investment to make. This is mainly general knowledge and knowledge that I've built up over the years of doing investments myself. And I think Benjamin Franklin said it best when he said, "An investment in knowledge pays the best interest." So for today's agenda, it's broken down into 4 parts. The first part is on risk-return trade-off, where I'll be talking about the different types of investment products. And then I'll be talking about the target rate of return on investments. Part 2 is on safety, income, and growth, where I'll be talking about life cycle investing. Part 3 will be on the different account types you can have, which include non-registered investment accounts, TFSAs, and RRSPs. And finally, I'll be going through some discussion questions, and I'll be also answering them as well. Now I'm going to walk you through some of the investment products that there are. So first is a high interest savings account. This is an account where money is put into this account and it earns interest, usually at a high rate, but you have the flexibility to use the funds whenever you need it, whether it's for emergencies, to pay bills, or to purchase a product. Next is a guaranteed investment certificate, or GICs for short. This is where money is locked up or non-redeemable for terms between 1 to 5 years, and it earns interest. Next is bonds. Bonds are basically money is invested for terms of typically 1 to over 15 years, while you receive semi or twice annual interest payments, and at maturity, the face value of the bond. And don't worry, I'll talk about what the face value of a bond is later on in this presentation. The fourth type of investment product are mutual funds and ETFs. So these type of investment securities pool investors' money together and invest in a basket of goods. So there's typically money market funds, balanced funds, and growth funds. The difference between these 3 types of funds are the underlying risk that you take. So money market funds typically invest in more government securities like bonds, so more on the fixed income side. And then as you move to the growth funds or equity funds, it invests primarily more in company stocks. But nevertheless, it provides more diversification than investing in any one security on its own. So now what's the difference between mutual funds and exchange traded funds? So mutual funds are more actively managed to buy and sell assets within the fund in an attempt to beat the market and help investors profit. But these typically come with higher management expense ratios or management expenses, and the fees are much higher, typically 1 to 2%. Whereas exchange traded funds are more passively managed, as they typically track a specific market index, and they can also be bought and sold like stocks on the market. As such, ETFs are more lower in fees than mutual funds. The fifth investment security is stocks and equity. These are securities that represent the ownership of a fraction of a corporation. This entitles the owner, you, the investor, of the stock to a proportion of the company's assets and profits equal to what proportion of the company you own. Now, some companies pay dividends, which is basically a distribution of the company profits to shareholders. So now we come to a challenge question. So my question is this: are bonds like GICs locked up for their entire term to maturity? So for instance, a $5,000 face value bond, which matures on June 6th, say 2040, does this mean you have to wait until maturity to get these funds? Welcome back. So I'm going to take up challenge question number 1. So the question was, are bonds like GICs locked up for their term to maturity? The answer is no. Bonds are traded over the counter and can be bought and sold anytime before maturity. However, bear in mind one thing. When you sell a bond prior to maturity, the yield or return on the bond is no longer guaranteed, and you can make a gain or a loss on the sale of it. So what does over-the-counter mean? Over-the-counter market is a decentralized market in which the market participants trade bonds directly between two parties and without a central exchange. So let's take an example of a bond from an online brokerage called CIBC Investors Edge. So you would normally go to trading, buy bonds, and then you will be presented with a list of bonds to purchase. And let's take an example of this particular bond and walk through the details. So in this case, the issuer is Alberta, so it's a provincial bond. The coupon rate is 3.3%. I'll get back to this in a second. The maturity is December 1st, 2046. So that's 25 years from today. So that's like, if we average 2 lockdowns a year, that's probably by the time we reach our 50th lockdown in Toronto, this bond will mature. The type is a bond. The credit rating is AA. So now any bonds with a credit rating of BBB and above, or BBB and above, are considered investment grade bonds. And they are the strongest type of bonds to purchase. Anything below BBB or BBB are non-investment grade speculative bonds. These are more higher risk bonds to invest in. So because this is a provincial bond, it's backed by the provincial government of Alberta, it's relatively a safe investment. The yield to maturity is on an annual basis 2.525%. So what this means is if you hold this bond to maturity in 2046 of December, on average you will get a return or a yield of 2.525%. The face value of the bond is basically, at maturity, you will get back $10,000. Now, what is the price today that you have to pay for it? The price today you have to pay for this bond is $11,674.11. Now, you might be scratching your head thinking, well, why would I pay today $11,674 for a bond that will mature and only give back $10,000 on the maturity date of December 1st, 2046? Well, that's where the coupon rate comes into play. So every year you make $330 of interest, which is 3.3%, the coupon rate, multiplied by the face value of the bond. You'll make $330 in annual interest, and because it pays out semi-annual payment frequencies, it means twice a year you'll make interest payments. That'll total $330 a year. Now, one thing to note here is if you sell the bond prior to the maturity date of December 1st, 2046, this return of 2.525% is not guaranteed anymore. And that's because the price of the bond will fluctuate every year depending on what happens to interest rates. So the general rule of thumb is when interest rates go up, the price of bonds go down. So if you sell before maturity, you run the risk of making a loss or a gain on selling the bond before maturity date. So with investing, there's always a risk-return trade-off. The higher the risk you're willing to take, the higher the return from your investments will be. Of course, the opposite is true. The lower the risk you take, the lower the return you'll get. So as you can see from this graph, I've put the different type of investment securities relative to their risk-return trade-off. So GICs are the lowest risk because effectively you would not lose your principal amount and your guaranteed interest. So it's the lowest risk, but you also get the lowest return. I think as of today, interest rates are like below 1% for an annual GIC. Next, federal and provincial bonds. They're a little bit more riskier than GICs, again, because if you sell it before maturity, there's still a chance that you can make a loss on bonds. Of course, because they are backed by either the federal government or the provincial government, the risk of default is lower than of corporate bonds. So company bonds are more riskier than provincial and federal bonds. Next, mutual funds and ETFs, because they provide diversification. As I mentioned before earlier in the presentation, mutual funds and ETFs have 3 different types. Money market, which focus more on like bonds, the fixed income side of more federal and provincial bonds. And then you have balance funds, which balance between corporate bonds, fixed income securities, and stocks. And then you have growth or equity funds, which primarily invest in company stocks. So again, the risk-return trade-off. Now, because mutual funds and ETFs, you do not invest in any one given stock, it provides more diversification than investing directly into a stock, which is the highest risk. So as you can see, stocks provide the highest return, but you take on higher risk than any of the other securities. So my target rate of return on investments is 5%. So does this mean that I only invest in stocks and mutual funds and ETFs? No, I invest in all of these type of securities such that my average return is 5%. And does this mean that everyone should target a 5% return? No, it really depends on your risk tolerance level. The more risk you're willing to take, the higher the return you can expect from your investments. So like day traders, they're betting on getting a high return, but of course they're taking on higher risk in that they might lose their entire investment. Of course, people who are more risk averse or people nearing their retirement years would want to protect their savings and wealth, and so they would focus more on fixed income securities to protect their wealth, but also to generate income during retirement years. Now, if you open up robo-advisor accounts, like let's say with Wealthsimple Trade, they usually ask you a series of questions, and what they're doing in those questions is trying to get a sense of what your risk tolerance level is, and accordingly invest either in growth funds, balance funds, or money market funds, depending on your risk tolerance level. So again, to reiterate, if you want more safety in your investment portfolio, you tend to focus more on fixed income securities. If you're looking for more income, again, you would tend to focus on fixed income and maybe some mutual funds and ETFs. And if you're focused more on growth, then you'll put more of your money into stocks. We have come to challenge question number 2. Why are corporate bonds generally of lower risk than a company's stock? Welcome back. So challenge question number 2 was, why are corporate bonds generally of lower risk than a company's stock? Well, for 2 reasons. Volatility. Stocks are more highly volatile and risky compared to bonds, which are more minimal to lower risk. And the potential downsides for stocks, you can lose everything with stocks. Whereas with bonds, the company's bonds, you can lose everything, but you can often recover at least something from the company's assets. If a company goes bankrupt upon liquidation of its assets, the following is the order in which people will get paid. So first would be the secured creditors, so banks will be paid first. Next, bondholders, which are considered unsecured creditors, will get paid. And finally, any residual value left of the company will finally be paid out to equity holders. So that's why a company's stocks are more riskier to own than a company's bonds. So life cycle investing is a process of investment asset allocation over time to reflect a person's changing risk attributes and financial goals. So when you're younger, between the ages of 20 to 40, you want to follow more of a growth, aggressive portfolio strategy with 80% into stocks and 20% into bonds. Now you don't have to invest directly into a stock. You can certainly buy growth mutual fund or ETF funds instead. When you're in your middle age, so like between 40 to 65, you want to follow more of a balanced portfolio, so 60% stocks, 40% bonds or fixed income. And then when you're a senior in your retirement years, you want to focus more on preserving your capital, all the money that you've saved, so more safety of a portfolio you want to have. So you would reallocate away from stocks, so you would only put 40% into stocks and say 60% into fixed income securities. Following this life cycle investing approach can significantly increase your long-term wealth while reducing your risk. Remember, if you're young, $1 today is worth more than $1 tomorrow. So start investing if you're younger today. Don't wait for years to go by and then start investing and saving your money. So yes, life cycle investing is geared towards younger investors at their start of their saving and investing journey. The earlier you start saving and investing, the more money you'll have toward your retirement years. Now, an older investor can certainly use life cycle investing if they shrink their timelines to suit their risk tolerance and target allocation by retirement, following the growth, balance, and safety portfolio. So in my case, if I was nearing my retirement years, my target rate of return, which is currently 5%, I would probably adjust it down to say, let's say 3%. So I'll move away from putting more money into stocks and putting more money then instead into more fixed income securities. And as I retire, more into GICs and government bonds for income. So I've gone over the various investment products, the risk-return trade-off, and life cycle investing of safety, income, and growth. But what investment accounts do we hold these investment products in? Do we hold them in a non-registered investment account, a TFSA account, or an RRSP account? Challenge question number 3. Why does it matter what account we contribute and hold the investment products in. Welcome back. So taking up challenge question number 3, why does it matter what account we contribute and hold the investment products in? So the key to contributing and holding particular investment products in certain accounts is to minimize your income taxes. So now I'm turning to the different type of investment account types. So you have first a non-registered investment account. A non-registered investment account are taxable investment accounts available to Canadian citizens. Non-registered accounts are flexible, offer tax advantages, and have no contribution limits whatsoever. Next is Registered Retirement Savings Plans account, or RRSP accounts. It's a retirement savings and investing vehicle for employees and the self-employed in Canada. Pre-tax or before tax money is placed into an RRSP and it grows tax-free until you start withdrawing from it, at which time it is taxed at whatever your marginal tax rate is at that time. Finally, there is the tax-free savings account, or TFSA. This is an account in which contributions, which are after-tax contributions, interest earned, dividends, and any capital gains earned within a TFSA are not taxed, and you can withdraw funds from this account tax-free. So the approach that I'm going to use to look at these different investment account types is to go through discussion questions in which we'll be touching base on these different type of investment account types. So scenario 1, John earns $45,000 annually from his employment, let's say, and has $6,000 to invest. Should he invest the money in a TFSA or RRSP account? Welcome back. So taking up scenario 1, if John earns $45,000 annually and has $6,000 to invest, which account should he put it into, an RRSP or TFSA? The general rule of thumb is when you are in the lowest income tax bracket, it's better to contribute to a TFSA over an RRSP account. Now, I don't want to get too technical in the Canadian income tax system, so I'm just going to provide a high-level overview. So whether you do your taxes yourself or you get your accountant to do them for you, basically you start off with your total income. So this can be income from your employment, business income, investment income, if you have rental income. This all adds up to your total income. And from that, you deduct any company pension plan if you have any, and any contributions to your RRSP that you claim for the year, you get to deduct from your total income to arrive at your net income. And don't worry about non-capital business losses and net capital losses from investments. That's another topic. So the main idea is when you contribute to your RRSP, the more you contribute to it, your taxable income will go down. That's the main relationship that you should know. As you contribute to your RRSP and you claim it for the year, your taxable income goes down. So looking at the federal tax rates for 2020, and obviously there will also be provincial tax rates as well, but as an example, I'm just looking at the federal tax rates for 2020. So on 15% will be the federal tax rate on the first $48,535 of taxable income. Again, taxable income is your total income from whether it's from employment, business, investments, rental, whatever the source of income it is, minus any RRSP deductions would arrive at your taxable income. So if you have taxable income of no more than $48,535, your federal tax rate will be 15%. If your taxable income happens to be anywhere between $48,535 and up to $97,069. On that portion above $48,535, you'll be taxed at a federal tax rate of 20.5% plus the 15% on the first $48,535, and so forth. So as an example, let's say your taxable income is between the $48,535, the lowest tax bracket, and less than $97,069. So say your taxable income is $54,535. Now in scenario 1, you do not make a contribution to your RRSP, so your taxable income remains at $54,535. In the other scenario, you do contribute $6,000 and claim your $6,000 RRSP on your taxes, in which case, again, your RRSP lowers your taxable income. Ultimately, you are at then $48,535 of taxable income because you contributed $6,000 to your RRSP. So it's exactly $6,000 less. Now, at up to $48,535, you're taxed at 15%, which is the lowest federal tax bracket. So in both scenarios, you would pay about $7,280.25. But because you did not contribute to an RRSP, the $6,000 in scenario 1, on that portion above $48,535, you'd be paying taxes at a higher marginal tax bracket of 20.5%. So you'd be paying an additional $1,230 in federal taxes that you would have to pay. So in this case, because you are in a higher tax bracket, it makes sense to contribute to an RRSP to help lower your taxable income so you're in a lower tax bracket. So scenario 2, where the person contributed and claimed a $6,000 RRSP contribution on their taxes, they put themselves in the lowest tax bracket of 15%, and so they pay lower taxes. Now obviously, as I said before, if you are already in the lowest tax bracket based on your taxable income being lower than $48,535, then it makes more sense to contribute to a TFSA account if you have extra money lying around than to an RRSP account. So let's look at scenario 2. John and Mary's only source of earned income is income from employment. Both earned a gross salary of $50,000 in 2019, or box 14 of their T4 slip. Mary had a registered pension plan with her company, and on her T4 slip box 52, which would show pension adjustment, had an amount of $5,350. John, on the other hand, did not have a company pension plan. Note, 18% of earned income from the previous tax year is the allowable RRSP contribution deduction limit for the year 2020. The question is, what will their respective RRSP deduction limit be for 2020? Welcome back. So the solution is, for John, 18% of his earned income of $50,000 is $9,000. So John will be able to contribute $9,000 to his RRSP account. Mary, on the other hand, again, would take 18% of $50,000, but because she has a company pension plan, she would deduct $5,350, and her RRSP contribution room will be $3,650. Now, if you notice, the total amount attributed to a person's retirement savings overall for 2020, regardless of whether your company has a pension plan or not, is still $9,000. The only downside for John is that he will have to save up and contribute the entire $9,000 on his own. So scenario number 3, Susan has maxed out her TFSA in each previous year and on January 1st, 2020 contributed $6,000. By March 10th of that year, she had earned income of $1,500 from dividends and interest on her investments within her TFSA account. She withdrew the $1,500 from the TFSA to purchase a new laptop. Then on April 30th, 2020, she got her new payroll deposit and contributed $500 back into her TFSA. True or false? There will be no implications from this, as you are permitted an overcontribution of $2,000 to your TFSA without penalty. Welcome back. So taking up this TFSA overcontribution question, the answer is false. You cannot overcontribute to your TFSA at all. And if you do, you will be subject to a 1% penalty tax per month as long as the excess amount stays within your TFSA account. So if Susan realized on, let's say, December 31st, 2020, of her overcontribution, she would incur $40 in penalty tax, which is basically 1% of the $500 for the 8 months she had overcontributed. Now, one thing to note is for an RRSP account, you are allowed to overcontribute to it without penalty up to a maximum of $2,000 of overcontribution. Scenario number 4. In which account, an RRSP, TFSA, or a non-registered investment account, is it most advantageous to hold US dollar dividend paying stocks? Welcome back. So in taking up scenario 4, in which account, an RSP, TFSA, or a non-registered account, is it most advantageous to hold US dollar dividend paying stocks? The answer is an RRSP account. Dividends on US stocks held in an RRSP are tax-free. RRSPs are viewed by the IRS, the Internal Revenue Agent Service, in the US, which is like equivalent to the CRA in Canada. They view the RSP as an account meant to provide tax-deferred pension or retirement benefits. So they do not subject any US dollar income that's earned in an RSP to any withholding taxes. Now, TFSAs, you might think, hey, it's tax-free, but no. The IRS does not view a TFSA to provide tax-deferred pension or retirement benefits. As such, you will be taxed. There will be withholding taxes levied on any dividend income earned within a TFSA. And it's actually worse off to hold US dividend paying stocks in a TFSA because the income that you earn, because it's exempt from getting taxed because it's a TFSA account, the withholding tax, you will not get any credit for it as you would get in a non-registered investment account. Usually with a non-registered investment account, you'll get foreign investment tax credits for any foreign investment income earned. Whereas a TFSA, you will not be entitled to it. So in fact, a TFSA is the worst account you can earn US dividends in. So your RRSP is the best bet. Scenario number 5. You purchased 30 shares of CIBC on March 23rd, 2020, which is a Monday. On the dividend payment date of April 28th, 2020, how much in dividends would you have received? And you can use the chart below to help. So looking at this example, you might say, oh, this is really simple. It's the quarterly dividend rate of 1.46 multiplied by the number of shares you purchased, 30. So you would say then that the amount of dividends is 43.80. Now, on the surface, that may look like the right answer, but in fact, it's not. The amount that you will get is $0. So you must be pondering, Matt, why is it $0? This looked like a very simple, answer to this question. You take the quarterly payment, multiply by the number of shares that you have. But what's important are these dates. There's the declared date, ex-dividend date, record date, and the payment date. These dates are very, very important and will determine whether you are entitled to a dividend or not. So what's important to note when it comes to stocks is that there's usually a difference between the transaction date, which is the date you physically go on to your online broker and purchase the security on, and when the actual stock, the transaction settles. So there's a difference between the transaction date and settlement date. Typically for stocks, we say T+3, which is basically the transaction date, which would be, in our case, March 23rd, 2020, plus 3 days, which would be March 26th, 2020, which is the ex-dividend date. So the declaration date is when the board of directors of, in this case, CIBC, would meet and they would declare a dividend for shareholders of record on March 27th, and that they would pay out the physical dividend of 1.46 on the payment date of April 28th, 2020. So what is the record date? This is the date when the board of directors looks at its official list of shareholders or investors to decide who will receive the dividend. The payment date is, of course, naturally the date that the investor or shareholder actually receives their dividend payments, which is April 28th. And the most important criteria is the ex-dividend date of March 26, 2020 in this case. The ex-dividend date is defined as the day on which the trade will settle too late to give the buyer of the stocks, so in this case the buyer of CIBC shares, the dividend payment. Simply put, the ex-dividend date is typically 1 or 2 business days before the record date. And because you bought CIBC shares on March 23rd, plus 3 days to settle, which makes it March 26th, which happens to be on the ex-dividend date, the purchaser of the CIBC shares will not get the dividend. So even though now you have the shares on after March 26th, the seller of the shares to you will still get and be entitled to receiving the dividend, and you will not receive the dividend. So your answer, of course, is 0. Scenario number 6. This will be the final scenario. John and Mary, brother and sister, each have $100,000 to invest and are roughly the same age, under 30 years old. Question: would they have the same portfolio strategy, which is, according to life cycle investing, would be more of a growth aggressive portfolio strategy. Welcome back. So continuing scenario number 6. John and Mary, brother and sister, each have $100,000 to invest and are roughly the same age, under 30. Would they have the same portfolio strategy, which is a growth and aggressive strategy based on the life cycle and investing? The answer to this is not necessarily. It depends on each one's individual financial situation. For instance, are they married? Have a plan to have children? Are they working? Do they have a mortgage? Etc. Before investing in products, you need to look at your current and long-term financial goals as part of the whole life cycle investing, not just simply your age. In addition, each one may have a different risk tolerance level, as I discussed before. If you're young and manage to save money for investing, then be sure to invest for the long term. Avoid day trading, buying and selling securities often. So I have to talk about this because this was in the recent news. Basically last month, GameStop's stock shot up from almost $50 a share to almost like $350 a share. So basically what happened there was hedge fund managers were shorting the GameStop stock, basically meaning they were betting that the price of the GameStop stock was going to go down. And people on the Reddit community, which are filled with people like you and I, retail investors, said, hey, let's change things up. Let's actually buy up shares in GameStop and drive the price up. And so that's what they did. They bought up the shares, and actually the market price went up from almost $50 to $350 US. And a lot of these, so basically you might be questioning me and saying, well, didn't day trading pay off for investors? Well, yes, it did. But I don't necessarily recommend day trading because it's very risky. Because imagine the people who bought the shares when it was $350 hoping that it would go up, but as of today it's only $41 a share. So I'd like to leave off with this quote, which is pretty much how I view investing. Investing should be more like watching paint dry on a wall or watching grass grow. If you want excitement, folks, take $1,000 or more out of your bank account and go to Las Vegas. So thank you, ladies and gentlemen. I hope you enjoyed this presentation and webinar. If you like it, give your thumbs up. And of course, if you want me to do other financial or tax-related videos, I'll be more than happy to. Just let me know what you'd like me to do, and I'll do it. Thank you.